And welcome back to the trade today. Now, Goldman Sachs is getting more bullish on U.S. stocks. It says the S&P 500 will have its biggest second-half rally in 27 years. Michelle McCory is at the heart of the action in New York and joins us now. Michelle, what do we know?
Hi there, Paul. Well, Goldman Sachs strategist David Kostin predicts the S&P 500 will end the year at 1,060. That's a rally of 12% from current levels. And this call comes down to his expectations for earnings. He thinks earnings will grow this year to $52 a share, even though the street widely expects earnings will shrink. Now, the two main reasons he thinks this, well, financial losses and write-downs will not be as bad as expected, and he thinks that the economic recovery in emerging markets looks increasingly promising, and that should help out, especially those companies exposed to the BRIC nations. That's, of course, Brazil, Russia, India, and China. And we do know that China just announced last week that its economy has grown by 7.9% in the second quarter. Paul?
Goldman is not alone out there. I know CLSA have said something similar in the past, but what's the general view amongst analysts?
Well, we do have a few bulls out there joining Goldman in this analysis. We spoke to Thomas Lee over at JP Morgan, and he agrees with Goldman's Kostin. He says that as emerging markets recover, so too will the U.S.
If global production ramps up, and let's say in the Americas it's 10%, 40% of all the jobs lost in this recession have been manufacturing. So you're going to see manufacturers start to hire again. That's going to help stabilize consumption. So there is going to be a trickle-down effect to the U.S. economy overall.
Now, JP Morgan is actually the most bullish among the biggest Wall Street banks. Goldman is actually the second most optimistic there. But, Paul, we also spoke to Barclays strategist Barry Knapp, and he disagrees. He says the S&P 500 will end the year below current levels at 930. He says that the banks that reported last week talked about credit quality getting worse, and that will lead to an extra $1 trillion worth of write-downs and losses for financial firms. So no recovery in those financial earnings, he says, until 2011. And the Barclays analyst also says that the consumer as well remains in very bad shape, and that will be a drag on earnings. Of course, there are other voices of dissent. As we know, Kate Stockton from MKM, she expects a big drop. Last week, she said that the S&P may drop 12% should it break below that level, watched by technical analysts who follow the Fibonacci sequence. Not going to explain the details of that, but she does expect a big decline in the S&P. We'll get into that another time. I know you know the details. But, Paul, also remember that unemployment is still the big blot on economic recovery, and the ripple effects of that are still not exactly certain, not exactly known how that will factor into consumer spending and, of course, into profits and shares and earnings per share. So, positive outlook from Goldman and the major banks, but still a lot of room for doubt there, Paul.
Yeah, a lot of divergence out there. But you're right, Michelle, if it's too early in the morning or too late at night, those Fibonacci sequences can drive you crazy trying to understand them. Thank you very much indeed for that. Michelle McCory there in New York.